Before I start this episode of our Grow It campaign, I want to say a quick thank you to the episode sponsors. They are Wealthify and Fidelity. I'm going to say a quick bit about each proposition, so make sure you listen to them, because later in the series, when I talk about the different propositions out there, they'll be useful to refer back to. Do remember that with investing, your capital is at risk, so the value of your investments can go down as well as up, which means you may get back less than you invest. That is relevant to each of the propositions I'm going to talk about. First up, Wealthify is a multi-award winning online and app-based investment service founded in 2016 and backed by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, £50 for pensions. Wealthify has a simple yet competitive annual management fee. Investment costs also apply, and offers a number of investment products, including a stocks and shares ISA, a general investment account, a personal pension, and a junior ISA. Within each of those, you can invest in a range of managed portfolios with varying risk profiles and even ethical portfolios. For more information about Wealthify, please visit wealthify.com/MTTM. Now, Wealthify does not offer advice. If you're not sure whether investing is right for you, then please speak to a financial advisor. Wealthify is authorized and regulated by the Financial Conduct Authority. Finally, I'd like to say thank you to our Grow It series sponsor, Fidelity International. Whether you're just starting out or an experienced investor, Fidelity offers a wide range of investment options with plenty of information, tools, and guidance to help you make more of your money and achieve your financial goals. For more information about Fidelity, please visit fidelity.co.uk/money to the masses. Welcome to episode 5 of our Grow It campaign. Now, if you've enjoyed this campaign so far, make sure you hit that like button and you also subscribe to our channel, and you'll get the rest of the series as well. So far in this Grow It campaign, you've learned about why you should think about investing, you've learned about risk, you've learned about return and taxation, as well as when you should seek the help of a financial advisor, and how you go about finding one that you can trust. Now, in this episode, I want to explain the basics of the account types that most people need in order to grow their wealth. So at the most basic level, you will presumably have at least one current account with a bank or building society, which your wages will be paid into and your bills will be paid out of. Then beyond that, you will want an easy access savings account to store your emergency fund with easy access, meaning that you can withdraw the money quickly if you need to. Now, this will pay a better rate of interest than your current account. That's why you use a savings account, but you do maintain that access. Now, when it comes to investing, there are a whole range of options out there. And before you get carried away with thinking about the assets that you want to invest in, I'm going to cover that in the next video in the series. You need to decide the product through which you want to invest. Now, these are often called tax wrappers, but it's easier if you think about them as boxes. So just think of cardboard boxes sitting in a row. Now, 3 such boxes are a stocks and shares ISA, a pension or a SIP, and a general investment account, which is often called a GIA for short. Now, I'm going to explain each of these in more detail in a second. So what I want you to do is visualize these boxes into which you're going to put your investments, be they shares, bonds, or whatever it is you want to invest in. Now, generally speaking, you can put the same types of assets into each box. So when you look inside the box, they will each look the same as the next one. But what makes each box special is the rules around not only how and when you can put money into them, but also when you can take it out again, and also how each box is taxed. Each has a set of rules covering whether you get tax relief on the money you put into the box, how the investments are taxed inside the box, as well as the tax you have to pay when you take money out of the box. So let's focus for a second on box number 1, which is the pension. Now, a defined contribution pension is a long-term investment product, and it's designed to provide you with an income during your retirement, and you put money into it and you grow that over time. It's a very tax efficient way of investing money because you receive tax relief on your contributions on the way in, and your money grows tax-free when it is within the pension wrapper. So in simple terms, when you put money in, HMRC also adds some money into the box via what is known as tax relief. And there are two types of pensions. So workplace pensions and personal pensions, which you can set up yourself. With a workplace pension, it is likely that your employer would also pay into it as long as you do under the terms of auto enrolment. So not only do you get money from HMRC through tax relief paid into your pension, but you also can receive free money paid into your pension from your employer. That is a win-win, and you can invest all of that within the pension wrapper so it can grow tax-free over time. Now, any money in the pension box is allowed to grow tax-free, as I've said. However, it can't currently be accessed by most people until they are age 55, although this age limit is set to rise. When it comes to taking money out of your pension when you retire, then this is subject to income tax, although 25% of your pension pot can be taken tax-free. Now, I won't go into any more details on this video, but I have put some links into the notes below this video where you can find out more information about how pensions work, how they are taxed, and your options at retirement. Now, one thing to bear in mind is that there are annual limits as to how much you can pay into a pension each year and receive tax relief, which for most people is the lower of your earnings in the given tax year and £40,000. But generally speaking, a pension is the most efficient way to invest for your retirement. Next, we move on to box number 2, which is the Stocks and Shares ISA, known as the Individual Savings Account. Now, it's a tax-efficient account that allows you to save or invest up to £20,000 each tax year without paying tax on the interest or investment returns. You don't receive any tax relief on money that you pay into a Stocks and Shares ISA, unlike a pension. But on the flip side, any withdrawals from your ISA are always tax-free, and your investments can grow tax-free all the time. They remain within the ISA wrapper. There are several other types of ISA out there, including cash ISAs, innovative finance ISAs, and lifetime ISAs, as well as junior ISAs. Now, I won't dwell on the different types of ISAs in this video, other than to say that your £20,000 annual limit is spread across all of them with the exception of the junior ISA. Now, we're going to come on to junior ISAs later on in this series. Now, a lifetime ISA is one that is of particular interest, however. So those people who are looking to buy their first home will be interested in a lifetime ISA because it offers all the attractive tax benefits of a standard ISA, but with the additional 25% bonus provided by the government. I've included a link in the notes of this video to an article on the Money to the Masses website, which provides more details on lifetime ISAs and how they work. While most LISAs, that's shorthand for lifetime ISAs, that you can get out there are cash-based, there are some stocks and shares versions. That means you can invest the money. Now, you can find full details in the article I've already mentioned. So if you are saving for your first home, make sure that you check this out before you go any further. So that leads me on to the third box, the General Investment Account. Now, that's the GIA for short. Now, this is a standard investment account that doesn't offer any tax benefits. You can still invest in a range of assets such as stocks, bonds, you can invest in funds, but you will pay tax on any income or capital gains that you make. Often people will use a GIA if they have utilised the annual ISA and pension contribution allowances. So now you know about each box, you can see that pensions offer significant tax benefits, namely tax relief and the possibility of employer contributions when you're using a workplace scheme, making them a popular choice for investing for retirement. However, you can't access your money until age 55 currently. ISAs, on the other hand, are more flexible in that you can withdraw your money from them whenever you want, tax-free, but they also have annual limits on how much you can save. They are a good option for short to medium-term investment goals or as a complement to a pension. GIAs offer no tax benefits, but again, they're flexible and offer access to a wide range of investment options, and they're often seen as a good option if you've maxed out your pension ISA allowances, as I've said. So it makes sense to ensure that you're not leaving any free money on the table via your employer pension scheme by joining it and ensuring your employer's paying in if they do, It makes sense to use a stocks and shares ISA if you want to complement that, as they are flexible and you can access your money whenever you want before age 55. And in reality, it's not actually a binary choice between any of these, with successful investors utilizing both pensions and ISAs and occasionally GIAs as part of their investment strategy. The main thing is that pensions, ISAs help maximize your investment returns through mitigating the impacts of tax on your growing wealth. Now, there are some other esoteric investment vehicles out there, such as VCTs and EISs, and I'm not going to go into them on this video because it's beyond the scope of this series, and they only are suitable for what the regulator defines as sophisticated investors. But I will put some links in the notes of this video where I've done a podcast that explain those products in more detail. So by this point in the series, you should be feeling fairly comfortable with the ideas surrounding investing, including taxation and the usefulness of tax wrappers. So in the next video, I'm going to talk about how to pick what to invest in and how to build a portfolio to achieve your financial goals. And so if you're finding this series useful, do make sure you hit that like button and you leave a comment, but also subscribe to our channel.